Oh, great. No, we still had another minute going. Okay. Are we on? Can you guys see me? Fantastic. Let's go with screen two to share. All right. We'll minimize that. You guys ready for this? Welcome. Bitcoin drama is back. Roaring Kitty is going to exercise his options on more GameStop stock. We got 80 companies about to report in the coming week on the S&P 500, and we're less than 1 month away from Doomsday. Doomsday, May 14th. That's why you're here, to hear me tell you what to watch out for in the next month. I'm Gordon Scott. This is Gordon Scott Charts and Chats with Gordon Scott CMT, and I'm glad you're here. All right, let's get started. Lots of exciting things to talk about today. And I can't wait to share with you everything we got. I'm just going to pull up my chat window so that I can see the chats when they come in. Okay, give me just a second to get there for that. Nope, that's not the place where the chat window is. There we go. Ah, there we are. Thank you. Good morning, Paresh. I got the chat. All right, here we are. Bitcoin, it's yellow right now. It's been going yellow and black. Yellow is up, black's down just over the 24 hours. Bitcoin drama is back. There it is. The middle of the weekend. Big old crash. And I mean, this is what Bitcoin does. Bitcoin is still a volatile asset. It's less volatile than all other cryptocurrencies, but it's still volatile, right? So we've dropped from a high of 64 last week down to what happened here, 52, right? So that's what are we talking about? 20+%. That's a bear market right there. Okay. And it's just like, oh yeah, Bitcoin, been here, done that, right? So really important that people understand, if they're playing around in cryptocurrency, it's still a volatile asset. It's still an emerging asset, and emerging assets are volatile. Now, the good news is, if it's behaving volatile and it's still emerging, it hasn't settled down. Hey, there's a chance it could go higher, right? Well, yeah, there's a chance it could go lower too and stabilize at some point lower than where it is. But uh, everybody is of the opinion right now Bitcoin is here to stay. The question is, where is it going to stay? Is it going to stay higher than where it is now? 500,000, as the Winklevoss twins like to throw that number around? Or is it going to go down to 5,000 or 500 or just five, right? It's just nobody really knows, because the technology, very cool that it is, the blockchain technology, very, very cool. Uh, can we really use it in society? And, here's the thing. The irony of Bitcoin is that people talked about it as, oh, I mean, early on, right? It's like anonymous transactions, drug dealers can use it. Wait. You mean like untraceable paper cash of a fiat currency? I mean, no, that's not the big deal that criminals could use it. No. The big deal about Bitcoin and its anonymous transactions is that you don't have to rely on the trust of a government somewhere. Okay. So why does that matter? Well, because name me a government that you know of in this world that isn't accused of corruption. I mean, credibly accused of some kind of corruption in the past century. Absolute power corrupts absolutely. That goes the old saying, right? It's hard to believe that there is a government out there that isn't susceptible. I'm not trying to, straight up accuse anybody right now of doing anything corrupt. Just long term, it's hard to believe that those governments aren't susceptible to corruption. And if they are susceptible to corruption, they are susceptible to having their currency corrupted by bad decisions. So, what exactly is Bitcoin going to do about that? Well, if Bitcoin is not run by governments, is not regulated or controlled by governments, it's just by people, then at least you don't have that worry, right? So, in theory, it could hold its value. But then again, if everybody, just individual people all distributed around the world, decide, you know what, cryptocurrency is a bad idea, we don't want it, and it goes away, what are you going to do? It's not a matter of corruption, it's just a matter of no demand. So it's a trade-off, you know. This credible, stable, reliable, we can get taxes from people whenever we want them, government that might or might not be corrupt, or this mechanism that likely has no particular degree of discernible corruption, but is susceptible to just the vicissitudes of people's whimsy, right? Don't know. We don't know which is better. And that's the great experiment that's going on right now with cryptocurrencies is, can we determine that one could be better than the other? We will have to see how that plays out in the decade to come. But until then, you have to watch out if you're playing in the currency markets or cryptocurrency markets about that kind of fluctuation. You have to be prepared for it. Why does that matter to us in the doomsday clock? Well, because cryptocurrency is the best place for us to get a pulse on what the speculator attitude in general is. If people are like, well, I want to buy a little more. I don't know. I think it could be going up. I want to buy because I think it could really be going up. You know, all that kind of attitude just lifts prices. And if in fact that attitude is building, then prices are going to keep going up. Well, I've been predicting that Doomsday, May 14th, is going to be a moment when people pull back. They're going to say, I got to take profits. I think it's going to be driven by tax behavior in the United States. However, there are so many dollars that could benefit from taking profits that once they start doing that, it could inspire and generate a lot of other people to be selling in other countries all around the world. Either way, it's going to bring US markets down. Now, I am extremely certain that there will at least be a little bit of selling. Will there be a lot of selling? Well, in the past, when these kinds of circumstances that create the 56-week pattern happen, which is what our doomsday clock is pointing to, is this 56-week pattern, they're significant. They can be very significant sell-offs. 10% would be a small scenario. 20% has happened frequently. So what do we look in for coming up here? It's really hard to say. But the less sell off there is, then the more of a big buy there is afterwards. So there's fantastic opportunity here, whether it's to the downside or immediately right after to the upside. You really want to be paying attention to the May 14th time frame and the dynamic. And so I'm taking another week here without a guest so that I can explain it in detail. Now, 2 weeks ago, it's out there on YouTube on the Charts and Chats with Gordon Scott CMT Actions to Wealth channel on YouTube. It's there, the recording, full look. If you're joining this show within the past couple of weeks and you didn't get to see my full-on explanation of the 56-week pattern, you want to go search YouTube and find that, because that will explain all that. I'm not going to go into it today. I'm just going to start talking with you about why, in fact, the selling is coming. Is it going to be huge selling? Don't know. Will the selling persist more than a couple of weeks and continue on through the summer and be a big bad bear market? Don't know. Right at this moment in time, it's not looking like that's the most likely scenario. However, let's cover a couple of things today that could unfold in the next 2 weeks that might actually make that a possibility. Because if in fact this market drops 20% within a 1 month time frame and it doesn't rebound more than halfway during that period of time, then it could continue going on through the rest of the summer. I really don't think that the US market is in for this big 50% drawdown kind of thing like it happened in 2008 or even more than that. I don't think we're in for that kind of a doomsday scenario. However, if we are, it will start in the middle of May. Okay, that's where we go. All righty then. Let's see. Uh, we got a couple of chats here really quick. Helen, hi Gordon. Did you read about the China miners' electric grid of Xinjiang being down that may have contributed to this? What I think, I don't know. I did hear that it was that this was selling in China and some concern. It was also some selling or some concern that U.S. regulators might try to get involved in cryptocurrency, and both of those were bad news and took it down. But what's happened in the past 24 hours is that it's stabilized right around 57. Just since we've been talking, we're down 57 to 56.9, right? So we kind of hit this sort of uh, equilibrium, if you could say. Yeah. So it's not taxes like you said last week, right? It's not that tax day April 15th that got moved to May 17th anyway, but it's not about people having to pay taxes. It's just the profit taking. That's right, because people have been around in the markets for a year. And let me just bring that chart up real quick. Is that why is that not looks like my charts are frozen there. Are there, V asks, is there a Roy? Any early indicators around May 14th confirm the crash? Yes, there we go. Finally, my charts moved. That's exactly what I want to show you here is some early indicators. So let's see. Oh, so that one crashed and went down. Bummer. I'm going to show you that one. I'll bring it up in a second. But first, let's have a quick look at what's going on right now. Early indicators right here. This is the first week. We're still 4 weeks out. Okay. But this is the first week and it's already showing up. Okay. Now, so here's what's going to happen. We've got the NASDAQ dropping a little bit over the weekend and then going up. Remember how I've been saying for weeks that the Aussie yen and the NASDAQ are 75% correlated. They're generally very correlated, right? Look what happened just as the weekend broke. Aussie yen down, NASDAQ up. We get right to the midnight line on the 19th and they reverse. NASDAQ down, Aussie yen up. Now, as of just within the past couple hours, they are in sync. They're both moving down. This divergence, what does that divergence mean? Well, I've said before that the reason the Aussie yen and the NASDAQ are correlated is that this is the carry trade and it represents global attitude towards risk. And the NASDAQ represents growth stocks and the US domestic as well as, global investors attitudes towards, taking risk, trying to make a good risk reward, right? So if both of these are people who are trying to figure out how they can, take a little extra risk and make a little extra money, and they're both working the same way, then that's an excellent indicator of whether or not people want to keep buying or if they want to pull back. If these are both going down, people want to pull back. The Aussie yen has been going down all weekend, or well, since Thursday even, really been trending lower. And yeah, carry trade. See one of the current, right? This is the carry trade. So that's been dropping, and and you're just right in there. This is a 15-minute chart. So just right in there, leading into um, the end of Friday and the beginning of Sunday morning, early or Monday morning if you're in New Zealand or Singapore, right? So this is all just things getting started. Continuous downward trend. People are pulling back in a big way. No. Just small move, right? And at first, it seemed like people wanted to jump in and just ignore this and jump into the Nasdaq, but that's not what happened. Look at that; it came back down. It's They couldn't hold the gap over the weekend on the NASDAQ, and that big drop right there. What happened? Why did this? Well, this actually corresponded with a tweet that came out that said Roaring Kitty, the guy, Keith Gill, who on Wall Street Bets kind of helped popularize the GameStop trade, that he exercised options in GameStop. He had 50,000 shares, 500 call option contracts, and he bought them probably pretty low. Anyway, he went ahead and exercised those options rather than just selling away. Why? You exercise options so you can hold on to more shares. If he held on to more shares, then he believes that there is still more short sell action to happen. That hedge funds are still trapped in GameStop. I kind of don't think that's the case. At least I think that they've all made mitigation plans, and they've tried to get out. Who knows? But the reality is, if he did that, then he believes that they're still around and there's still money to be made. So what happened when he did that? Well, let's check out GameStop here real quick. That GameStop's up to 172. Well, it closed back down here in the 150s. The fact that it's even at 150. Now, I bought GameStop 2 or 3 weeks ago, and I just bought a small number of shares with no stop loss intended. I'm not usually a buy and holder. I'm not that kind of a trader. I'm usually a quick trader, but I bought GameStop knowing that the extreme volatility would make trying to figure out a stop loss untenable. I just wasn't going to be able to find a good place to get in. So I got in, and this was after the big run up to 400. I didn't get in at 400. I waited until it came down, got in somewhere in the 100s, and then when it got up to about 220, 230, I want to say, I took the profits there. And no. Come to think of it, it was higher than that. But the point is, the amount of money that I made was worthwhile, right? But now I sold out when it was up in the 200s, and then it came back down at about 180. I took that money that I had made and got back in. So I'm just playing with house money now, right? Not a lot of shares, just small number of shares. And so I got in at 180. I've been watching it goes down to 150, and I was expecting it was just going to go to zero, and I was going to be giving it all back. Now is the time. The gig's up. It's over, right? No, it hasn't. It hasn't gone away. I really don't believe that there's this huge hedge fund community that is about to get stoked by staying in GameStop. But if there were people out there that were really having trouble and being stuck in that um, trade, then that would really be interesting because it would tell us that um, sorry, I'm messing with the chat window. It would tell us that large institutions still have exposure to the GameStop trade. And if they have exposure, they have to sell shares to reduce their positions into cash. They have to move some money to safer places. They have to hedge. They have to get safer with their money because they know they're going to take losses later on somewhere in GameStop or related trades. If in fact that were true, where would you see evidence of it? You would see evidence of it in the NASDAQ, in the growth stocks. And if in fact GameStop goes up because somebody tweets out about Keith Gill's, grabbing 50,000 more shares and the implied belief behind it, and that scares traders into saying, we got to get out of here because the NASDAQ is going to come down if GameStop is going to go up. Now, I don't know that that's actually what happened, but it's hard to explain this drop right here. There aren't headlines out. You go looking for headlines on QQQ. Coca-Cola reported, but Coca-Cola's up. The report was good, right? That's an interesting thing too. Coca-Cola one of the 80 companies, 79 to be exact, of the S&P 500 that are reporting earnings this week. So that's about a sixth of the S&P 500, and this isn't even the big week. The next week after is the big week. But this week we will see Netflix and IBM and a bunch of others all report, and that will kind of get the ball rolling. We've already heard the banks last week. The banks came out. In fact, I talked about this. Hey, the banks were coming. Did you notice the banks all had fantastic news? I kind of thought that they were going to have good news, but the question I said last week was, what will people do about it? What will they do when they see the good news from the banks? Well, they sold. That's what they did. Almost, well, no, 5 out of 6 of the bank stocks that sold. Let's see if I can bring up. Well, this is another chart I got to show you here in a second. But before I do, I'm going to run over here and just show you J.P. Morgan. J.P. Morgan's earnings were so good that they, if I can bring them up, or there they are. The estimate was 310. They reported 450. That's a 50% surprise, right? Really big. And they also said that part of the reason that was so good was, we had a whole bunch of money set aside because we thought we were going to take losses from COVID. We haven't had to take the losses. So we had a good quarter, right? But what happened is after they gave out that good news, if you can see it, but this is the day right here, Dropsville. I mean, the market punished the stock. It dropped by 2 or 3%. It wasn't huge. It wasn't this collapse, right? But on such good news, that should have sent the stock $10 higher, 10% higher or better on that kind of news. That much more profit available? No, no, down it went. Why? And it wasn't just J.P. Morgan. It was like I say, 5 out of 6 of the big banks. Goldman Sachs, Wells Fargo. Wells Fargo actually went up, had a good quarter, went up. But see, Wells Fargo isn't an investment bank. Uh, Goldman Sachs, Morgan Stanley, um, uh, um, uh, Citi, Citicorp, Citigroup, and um, Bank of America. Now, these people all have big investment arms, and all of them had great results, but showed selling right out of the gate. This is an effect called sell the news. Okay, buy the rumor, sell the news. That's how the old saying goes among Wall Street guys years and years back. And the idea is they anticipate good news is coming, so they're buying it, and then the good news comes out and they sell it. They sell it all. Why? Because then the good news comes out, then in theory, the retail trader comes plowing in because they're like, oh, wow, that's good news. I think I'll buy some of that. Great, fine. I want to sell you mine because I already caught the run up. And from here, I don't think it's going to be all that good. And so they sell, right? Um, yeah, right. Roy's saying that's funny. Where's Wall Street coming to if they're worried about guys on Reddit? Exactly. I mean, why should that matter? But it does matter if you've got a bunch of those banks, the JP Morgans of the world and so forth, who have see what happens is those banks fund smaller hedge funds like Melvin Capital or the one this it happened to Credit Suisse here recently. You might have seen this stock on uh, um, CBS, Viacom CBS, right? We remembered about this, and no, that's not it. I'll go back to GameStop. That's a sidetrack. It's a really interesting story. Maybe I'll tell you. So where are we? So we're still up 173 on GameStop. Okay. Why does this matter? Well, if this goes up, and the people that were short down at $20 a share, right? They're or $50. I don't think GameStop was ever that high. I think it was they had to have been short between 40 and 20. and it was easy money. They're gonna short, they're gonna super short, they're gonna naked short, they're gonna leverage and keep shorting. They're gonna borrow money so they can go short on GameStop because GameStop's going out of business shortly. That was the trade. That was the idea they had. And so they put a bunch of money in there. Well, a big company like a Goldman Sachs or JP Morgan, they're not going to do that. They're not going to dirty their hands with that kind of stuff. But they are going to take a little bit of money, you know, 50 million here or there, maybe 100 million, hand it to a hedge fund and have that hedge fund do it. And a hedge fund goes, and this hedge fund's a smaller, kind of boutique operation. We're talking Ray Dalio or Warren Buffett or any of those guys. It's not the big stuff. It's these names you've not heard of before. They're mid to small in the hedge fund space. And this money, there are people in the financial markets that kind of look for the match between the big guys and the medium and small guys. Like, hey, we want some high risk stuff, something where we can get 20 to 50% returns on, but we don't want to put a lot of money. We just want to put some of it in there, right? So they do that, and then this middle group gets them kind of shuffled around. They make some agreements, counterparty trades, blah blah blah, and now they're tethered to that performance. The problem is that if that hedge fund goes poorly, then it reflects back on the big bank. Well, they they take that into account. They're like, okay, we're going to put out 50 million or 100 million, and we know that it could it could go away. It's all right. We could survive that. We're talking about a $4 billion fund over here. We lose 50 million somewhere. It's a rounding error. No big deal. On the other hand, if all of a sudden that 50 million comes back and turns into 75 or 100 million in what we invested, that's going to make this little blip just sort of improve everything. We're going to like that, right? And you never know. These guys could 100% return, 200% return a year. That's what hedge funds can do if they get a wild strategy, right? So the thinking is, give them a little something. What they don't expect is that hedge fund could possibly lose 10 times as much money as they gave them. If in fact they were given $50 million, they don't expect that somebody's going to come back and say, hey, we lost more of your money than you gave us. We lost 500 million of your money. What the actual, right? No, they don't expect that to happen, but that is precisely what would be happening, not could happen, is happening if in fact the GameStop trade is as lethal as Keith Gill and the guys who saw this trade early enough on Wall Street Bets believed that it was. I'm not saying that that's what it is, but when we see this happen and the Nasdaq drop at the same time, that's like confirmation that those guys might have been right, and it would be super scary for these hedge funds to lose as much money as they did. Well, we already heard that Credit Suisse lost a bunch of money because they were connected with Viacom CBS. But it wasn't so much Viacom CBS, it was this hedge fund that was long. And then all of a sudden they had to get out all at once. They had a margin call. Why did that hedge fund have a margin call? Where did that come from? Why did they have to pull all of their money out of CBS all at once? Well, the news has reasons why, but what if they had to pull that money out of CBS in order to fund their losses on GameStop? And what if there were more funds for whom that were true? And all of a sudden, they had to start pulling their money in order to cover their losses before the quarter was out so that they could kind of paper it over. Well, if all of that were a real scenario, and if they were waiting for tax break to occur, that is to say, if you hold a position longer than a year, then when you take profits or even losses, you pay a lower rate of taxes than you would if you cut out early. So is it possible that these guys are waiting and wherever they're stuck until May 14th? Because if so, then they will all come out together in a rush. And this sell off that I'm talking about really would be doomsday. We could see huge, huge market drops, perhaps bigger than anything we've seen. We're talking 10% circuit breakers. It opens 5 minutes later and drops another 5% and hits another circuit breaker. We could see 15% in 1 hour of trading somewhere on or around May 14th. Wouldn't that be wild? Well, I'm not predicting that I know for sure it's going to happen. I'm just saying that these are the dynamics that, if they were out there, really could happen. So, indicator one, GameStop went up and NASDAQ went down, and it's staying down. Okay, that big drop, and then it's staying down. Okay, that's number one. Number two, let's go over to the 10-year interest rate note. So the 10-year interest rate note is going up, and the bond funds were going down because of that. But then the 10-year just in the past 10 days dropped, right? From 1.5 point to 1.3. I mean, it's kind of a big drop. It hasn't dropped as much as it did just in the past 10 days for a while. It's still tiny little interest rates compared to historically. I mean, I remember having an 8% loan on a house I bought as a young buck years ago, but now we're down at this tiny little bit. Does this matter? This difference between 1.5 and 1.3% in the big scheme of things? Yes, it matters tremendously. Why? Because if this is going down, bond funds are going up, right? If this is going down, what it also means is that there is less demand for loans. That's an interesting thing. So far, we've seen nothing but high demand for mortgage loans, credit loans, and all sorts of other stuff, right? Except that out on Zero Hedge, some of you guys might know about it, zerohedge.com. You should check it out. There's a story out there about the money, velocity of money. It's all the way down. It's problems the Fed's having. It's a great read. You go into it and there's some details, and I just running out of time already, and I don't want to get there. This is the killer chart, though. The velocity of the M2 money supply from the US Fed. And what this is tracking is how much of the money that the Fed is putting out is turning into actual loans, or is it just sitting in bank deposits not being loaned out, right? Because the whole idea is if the Fed makes money, they want banks to turn around and loan it so that it gets into the economy, so that spending happens, so that the economy grows, right? Okay. COVID killed a bunch of economic activity. They thought they could revive it this way. And so they did. They made a bunch of loans. Except what's been happening recently here is that this huge drop and these are years. This is like, the 70s, 80s, 90s. But for a long time, it's been dropping. The big point is right here. Just in the past year, it has collapsed. This line down here at the bottom is 1.0 on this scale. This is 2.2, and but basically 2.2 means for every dollar that the Fed is putting into a bank, $2 are being loaned out on it. Okay, we're about to get to a point here where we get to 1.0, which means that for every dollar the Fed gave, if you go below 1.0, then that means the Fed's putting more money into banks' pockets as deposits than is actually getting loaned out. When you consider the fact that banks are capable of loaning out $1 9 times, if they're only loaning out the same amount that they're getting in or less, that means loans are not happening. That's really bad from the Fed's point of view because they expect that to drive economic activity. Well, if it isn't driving economic activity, then what, right? Okay. If in fact this is coming down, the 10-year note is coming down because there aren't enough people that actually want to make loans, surprisingly, then that would be a bad signal. It would mean that the economic activity that has been happening, has been pretty good, will not continue in the next second quarter. And if people get a sense that that's going to happen, then they're going to take profits. They're not going to take profits right now. When are they going to take them? After a year from when they bought at the bottom of the post-COVID situation, which was last year, right? They're going to wait. They're going to wait till that year, and that's what Doomsday is all about. So what do they do when they decide to sell? They don't just say, I'm going to sit on my cash. I mean, maybe they do, but most people move it to other assets. They move most large scale investors. They want to keep their money working. They just got to figure out where they're going to put it. So one of the places they would go is gold. That's less and less so. But if they don't go to Bitcoin, remember what happened with Bitcoin over the weekend, right? 20% drop. Eesh, don't know if I want to go there, says Big Fat Bank. Instead, I'll go back to what I used to think of as safety, gold. And what's happening with gold? In the same way this is coming down, same time period, gold has been going up. And that's where it is. Gold's on its way up. Not huge. I mean, it's not even recovering where it is just a couple of months ago, but it is turning that downward trend into upward trend. The timing is suspicious. Plus, look at this. This over the years, I got to tell you guys, I went back and looked 100 years of data. The place money goes when it's scared is the utility sector, the electric companies, the water companies, the monopolies in government that they pay out dividends. Their stock doesn't go anywhere, but they pay out big dividends. And so you make your money on dividends. Low volatility, high dividend payouts, safety, right? That's what they think, especially if interest rates are low. The yield, the dividend payouts on utilities are better. And what's been happening with utilities? Look at this. They've been on an upward trend anyway because the stock market's been upward trend. But in the past 2 weeks, acceleration. They're moving up much faster. And you don't hear headlines, utility stocks are doing well, they're just killing it in profits. No, it's not because they're making profits. It's because potentially people are scared. Big investors are scared and they move their money here. 90% of the time, if this happens, if a big run up in utilities happens and the market gets more volatile at the same time, and that goes on for 2 months in a row, 9 out of 10 times that signals a bear market to come. And could this signal a bear market? Not yet, not yet, but it's building. So, Roy, you're asking for, hey, is stuff, is this stuff, is there evidence of it coming? Yes, that's what I'm telling you. So far, evidence 2, evidence 3, evidence 4, evidence 5. This is all real subtle stuff. But check out the China trade. Here's the bottom post-COVID. This 2020 over here is 2021, right? Nice, strong upward trend in Chinese stocks. If you draw a line across the bottom there, we broke that trend line, and we're not collapsing. We're kind of holding there. But that big drop right there and the cut of that trend line, that's familiar. I don't know if any of you were watching what happened in 2008 and again in 2015, end of 2015, early 2016, and a little bit in end of 2018. The China trade failed before the U.S. trades, before the U.S. indexes failed, about a month or two ahead of time. Could it be that this is going around again? As I say, this is all circumstantial. Don't know. Don't know if this is all hard and fast evidence that this sell-off that I'm predicting is coming will really transpire. But it's not isolated data. There's little bits and pieces. They're all bubbling up. Well, we're still a month away, right? And the last time this happened, COVID, February 20th, that was a 56-week pattern day, February 20th. That was the tip top of the market. And you watched the VIX and a few others, things that were bubbling up for the month leading up to that. There were headlines about COVID and there was lots of worry and all kinds of stuff happening, but the markets weren't dropping. Low volatility, higher, 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 and then all of a sudden, boom, down it went, right? Could be that it'll happen the same way. Lots of bubble up, and then all of a sudden it'll break and go. I don't know. It could deteriorate between now and then. Usually, if you go straight up and then crash, that means that the rebound will be better. If you deteriorate into it and then crash, that means the rebound will take a while. So I'm kind of excited about the fact that we're seeing the markets continuing to go higher and higher right into doomsday. However, between now and then, as this month unfolds, keep an eye out because it could get ugly. So David says, for my UK Brent crude long after last week range, if it are looking for my UK long after it breaks the range to the upside. That's a good thing to be watching. See, oil, everybody thought the oil trade, the energy trade was just like no looking back and off we go, right? Then all of a sudden this huge volatility comes in just 2, 3 weeks ago and looks bad. Now it's resurging. Okay, cool. I don't think that there's going to be any particular correlation between oil. In other words, the oil market's going to collapse and then that's going to make the no. Oil's going to lag behind. If the market goes down, if the US market goes down, oil will go down on the other side of it. What's all this about? I think people got ahead of themselves. I mean, oil way back, COVID was terribly underpriced, and they were like, "Hey, the economy's going to open up, travel, et cetera. It's going to be good." And so then prices started coming up, and then right through here, earlier this year, you get oil producers all over the world, U.S. As well, especially since right in here, uh, the Biden administration cut the Keystone Pipeline, which is the pipeline of oil that comes out of Canada into the US and the northern part of the US. And that just means that the US was producing less oil. Well, once prices get further up, then there are a lot of small well owners and oil producers in the US. They're like, I'll find some other way to get the oil out there. But meanwhile, I've got oil and I want to sell it. And as these prices go higher and higher, the more and more they want to try and do that, the more and more money they'll pay to transport it through whatever means and get it into the market. So I think what happens here is that's the market's recognition that we've got oversupply coming on. With that oversupply coming on, now that's WTI, West Texas crude. Okay, so what you're talking about, Brent crude, um, that could get the benefit of that move up. I mean, they're not gonna pull far apart, but Brent's going to be on the high on the upper end, right? Because the U.S. Has more expense getting it. U.S. producers have more expense now getting it out because of that stuff. So anyway, the main thing is there is some concern at the current price level that there might be oversupply. If in fact there is, if in fact the market starts selling off and that just curtails demand, people like, oh, I can't afford to travel. I just lost too much money in Bitcoin or growth stocks or whatever. I can't go anywhere. Well, if that's the truth, then there's less demand. So it's going to lag. It's going to lag behind. You're watching a UK Brent crude long. I think that's a great trade right now. I like that. I like the idea that it could go and make new highs, but watch out for the May 14th dynamic because if it happens, oil will probably be right behind. Um, so what do you do about this? What kind of trade could you make? Well, I have a list of stocks that I shared that you can go short on. I've also talked about ETFs you could buy that well, Shukri's asking, will buying VIX options be good for Doomsday? Shukri, I'm glad you asked. I'm glad you're here because I've got a trade that's even better than VIX options for you. And I think I got enough time to do it. Yes, I do. And now is time for me to start talking about it. So let's talk about calendar spread. All right. Let me go back up. So there's a thing in the options market called a calendar spread. Now, first off, if you don't know anything about options, but you want to learn, uh, I believe that Actions to Wealth is going to be promoting a options class that I'm teaching at the end of May. So be sure you sign up for that. Not high cost, but it will be high value information. I'm going to take you from the basics of, what are options, how do they work, how do you really, what are the things you got to watch out for? Time value and time decay is what you really have to watch out for. Most beginner option traders don't know anything about that. So we'll cover all of that, and then we'll get to, okay, well, if I know all that now, how do I really make money? The big thing I'm going to talk about are two spreads, calendar spreads and diagonal spreads, and how you can use those to make a tremendous amount of money. I want to give you a little taste of that right now. So there's a thing called a calendar spread, and this is the lowest cost, biggest win way to make money. And if you're a polar bear trader, wink, wink, shukri, this is for you. And for those of you who know, I'm talking about the kind of trading where you put in a little bit of money and you expect to lose most of the time, but every now and again it goes really big. And it's a small percentage of the time, but it's so big that it pays all your losers and a whole lot more afterwards, right? This is that kind of trade. Trade I'm going to describe here isn't a trade that you necessarily win, although in the class I will be telling you how to increase your odds not from a 20% winning rate to more like a 45, 50% winning rate. So anyway, it's a fabulous trade. The calendar spread goes like this. You buy an option and then you sell a similar option, but closer in expiration time to cut out the excess time value. So you're not just watching your option waste away. Now, Shukri's asking about VIX options. Wouldn't be VIX because, VIX goes from so low, 15 where it is, up to who knows, 40 or 50, triple in value. Wouldn't that be a good thing? Yes, it's true. VIX options would be good because they spike. The problem with VIX options is they don't hang around up there. They're up and they're gone, and you gotta hit it. But you don't know where the top is. You don't know if it's 30, 40, 50, if it's 80. You don't know. But that top lasts one day and it's gone. And in fact, within one day, it's just a single hour. And when it's way up there, the VIX options spread way apart. And even though the middle is still pretty good, you lose a lot of slippage from that. So I'm not a big fan of VIX options, as interesting as they are. I am a big fan of what I'm showing you here. A calendar option on the downward direction of an index ETF. And I'll show you the killer trade that this sets up. So what you're going to do is you're going to buy a put option that expires in July, as an example. In fact, I am in this trade as of just late last week. I decided to initiate it. I will initiate more and more of these if, in fact, the May 14th scenario continues to play out. But you'll see why I'm doing it. It's fabulous. So a put option that expires in July, but I'm going to sell an option that expires in June. So I'm going to take out most of the time value. I'm going to put this strike price on quite a ways away. The example is I'm going to use IWM. That's the Russell 2000 ETF, small cap ETF. I'm going to show you that chart in a second. And the put option at the 200 strike, and I'm gonna buy that July and I'm gonna sell that June. And hopefully I got enough time here to show you how the numbers look on that. Let's see if I've got the option chain. Here it is. Ready for this? Watch what happens when you do this. Okay. So first I'm going to come down here to see if I can, there it is, show you what see, we're on spread single. Okay. So this is just the regular option prices. And I've got July and yeah, so July now, come on, be good to me. There we are. Yes. Here it is. All right. So, oh, sorry, I've got to show you the chart so that this kind of makes a little sense to you. Okay. But stick with me on this. You're going to love it. All right. So this will make sense. Here is IWM. This is the Russell 2000 index. Of all of the major US market index, this one is the weakest. The others, Dow, S&P, and NASDAQ, they're all up next to their highs. Well, when they open here in a few minutes, they're probably going to be down off those highs, but not collapsing. The IWM isn't anywhere near its highs. So relatively speaking, it is weaker. If everything goes down, this is going to go down faster and go down more. This is a head and shoulders being formed. If in fact it comes down to this level, the head and shoulders prediction is that whatever the height is, that's how much more it's going down. We could see that thing hit 180, right? If in fact May turns out to be bad, like I'm predicting that it will be, I mean selling at all, then we will at least get below that line right there, 200. We will break those old supports and then we'll go down and make a new low. That's the gap in right at the beginning of the year. And at a minimum, that is going to hold. Okay. So if in fact that holds, if this comes down to 200, turns right back up, boy, you really want to buy that because that's a signal that the markets aren't going to do doomsday. They're going to do a whole nother round of speculation. And then that'll last for, potentially to the end of the year of 2021. But If they come down, they're right up here at 220.5 or so. If they come all the way down to 200 and break through, they could get all the way down to 180 somewhere by the end of June. And so I'm targeting 200 just in case they get that far. And if they do, by the time they get there, the trade will be very profitable. And at that point, then I can close the 200 that I sold and let the other one run. And um, so that's the chart strategy. Starting early while we're here, it runs down to 200. Now you look at this, you're like, well, what if you're wrong, Gordon? What if it just takes off and makes a new high? Well, then I make a loss. But this is the fun part. Loss is fun? Yeah, watch. $3.33 is the ask, 323 is the bid, right? That's what I would have to buy the July option for, $3.33. That means this is a $200 strike, right? Oh, yeah, it just jumped down. So that's 199. 200 is 348. Excuse me, 348 by 339. That's the 200 strike, and I got to pay 350 for it. So really, that thing's got to get down to 196.50 in order for me to make any money at all by expiration. 350 is the fluff built into that. Well, that's the time value. What if I could just cut out that time value? The answer, I do that by selling the June 30th quarterly. Look at this. 200 is 271 by 282. So I can collect 271 and sell out 340, right? What is the difference going to be? I'm going to show you. So if I change this from single to calendar, this is Thinkorswim layout, by the way. I have both a Thinkorswim account and a TradeStation. They're both good. Thinkorswim's easier for me to show it to you. That's why we're looking here. So here's the calendar spread right up top. 200 strike. And look at the price of this thing. 57 cents bid by 77 cents ask. You probably get it for 68 cents. You put in a 68 order. It'll take a few minutes, but it will fill. 69 will fill instantly. You don't have to pay 77 cents. I mean, we'll see when it opens. When it opens, all these numbers are going to shift around here in about 8 or 9 minutes. But just as an example, we're talking about $3.50. No. You can get this for under $1. What that means is literally you can buy 100 shares of this trade for only $65 plus the commission, which is less than $5 on Thinkorswim and on, it's like $1.50, $1.60 per contract or something. I can't remember, but it's cheap. So you're in it for one contract at less than, say, $70, which is great. If you have a $7,000 account, no bigger than that, then you're only risking 1% with a single contract with no stop loss, right? But what could that do? What could that become? Well, if in fact you make it down to 200, this is not holding till expiration. You get down to 200 anytime, that thing is going to become worth about $200 to $300. So it's going to pay off 3 or 4 to 1. If in fact, when it gets down there, you close the June option, take the loss and just let the July run, then that July option after 200 now goes dollar for dollar. And so we're talking about getting to 180, 188, something like that. That's $12 intrinsic value, let alone whatever the time value is on top of that. $12. You paid $70, 70 cents is, and you're going to get $12. $12 for 100 shares is $1,200. You're going to buy this trade at $60, and it is potentially going to pay out $1,200. You see what I'm talking about there? That's massive, right? That's 20 to 1. That's your polar bear trade, Shukri. How about that? I think it's a little bit better than a VIX option. Could be wrong, but that's a way to make a very small amount of investment. And if you're wrong, that's what I'm telling you. The fun part is I'm out $70. no big deal, right? But if I'm right, it could be tremendous gains. And so there's that trade. I'm out of time here to start another trade, but next week I'll show you the version of this trade that I did also this past week on Apple. Apple is even better. You can literally, well, I was able to literally get into the equivalent trade for Apple with $20 per contract. $20, crazy good, right? And the potential payout for that is $500. So yeah, really good trade setups for this scenario. Shukri says he got it. Good. So anyway, that's just a little bit of a taste of what I would walk through in the options class for anybody who attends. Keep an eye out for when that starts getting promoted. As I say, I believe it's happening the last week of May. We'll see if they've changed the schedule or anything, but I don't think they have. Last little fun thing to tell you about. Yes, let me grab this. This is for a better, more complete understanding of this. There is a nice article on Investopedia. For those of you who don't know, I'm part of the financial review board for Investopedia, so I read a lot of articles, and whenever I come across a good one that talks about something I'm talking about, I like to share it. So I'm going to put it in the chat link, and Mai, if you could forward that on to the uh, other platforms, Facebook and YouTube. There we go. There's the link. And if you can't get the link, thank you, Mike. If you can't get the link, but you're listening to this, it's just right there. Just search for this title: Options, Implied Volatility and Calendar Spread by Jay Keppel. And it is a nice um, explanation of the calendar spread and how it all works. And it fits with the kind of trade. The specific example I gave, there's a lot of ways to trade calendar spreads and they're all good. but the one I just described to you uh, and a couple of variations of that are the best. And so I'll go into more detail about that. But here, if you read this and it isn't Greek to you, if you look at this and you say, I think I can follow that. I think I understand that. Well, then you're going to love the class. If you find I can read this, but I really don't understand it and I want to know more, then come back in the weeks to come and ask those questions here on Charts and Chats with Gordon Scott CMT. And you and I will have a chat about it. And we will get you the education you need so that you can be ready for this big opportunity, which so now let me tell you in the last minute or two here before I wind it up, what are you looking for in the coming week? We have all these earnings that are coming out, all these companies that are going to be doing earnings. And what we want to watch for is how does the market react? First off, are the earnings bad news? That all by itself is, more fuel for the fire. Again, like last week, I do not expect companies to be reporting bad news. It's way too easy. A year ago, everybody was doing terrible. So the year over year measures, they're all going to be great. If analysts said, well, we expect that, earnings will have increased 100% from last year, and then they come in at 150%. I mean, people aren't going to feel like, well, yeah, those COVID earnings were terrible last year. Everybody had a terrible year. So everybody one year compared to last year looked great. But it's better than that. There actually is a lot of good economic activity going on out there. There's a lot of intrinsic value. People should be excited about the news that they hear coming out from companies. Coca-Cola reported, yeah, the Greeks. You caught me. Good. So um, Coca-Cola reported, and it was good news, and so they should be up to start the market. What do they do though throughout the day? Do people sell Coca-Cola as the day goes on? I'll tell you, if Coca-Cola closes lower than where it opens today, that's not retail traders. That's not mom and pop or stock market enthusiasts saying, "Oh, sell Coca-Cola," right? They're not doing that. That's institutions. That's institutions saying, "We got our profits, let's get out of here." Why are they saying, "Let's get out of here"? Well, they got their reasons. right? And the fact that the utilities are going up, we're going to keep an eye on that over the next week. We're going to see, are people going to hear the good news but sell out just like they did with the banks last week? And then are we going to see utilities continue to push higher? If we do, if that's what we see, then we will know that the big guys are worried. And if they're worried, they're going to try and sell out, just sneak out as best they can. But come May 14th, they're just going to let it rip because they've made so much money year over year, 40% from the lows or 60%, depending on what stock or what index they were in. They made a lot of money. They can afford to take short-term decreases in the price. And if they got to sell a whole bunch and they lose a bunch by doing that, they don't care. They don't care. They don't care the difference between 45 and 38% gains. Those are great gains over a year. So they don't care if they have to give up a bunch. I mean, true, they wouldn't want to if they didn't have to, but they know that they're fighting to be the first one out the door. So they're going to run and try and just like, whatever, if we don't, just get out. Just take what we got because we need that cash to get ready for what's coming later, right? That's the way they'll think. That's the way they'll play the game. And so we got to watch and see how serious is the selling. Well, we just started. We got down a little bit for IWM, and right out the gate, what's happening? There's a little selling. Let's run back to our Aussie yen and Nasdaq chart. Nasdaq is buying. Aussie yen is drifting higher over the past hour. Nasdaq we saw was drifting down, but just here in these first few minutes, it's buying up. So the collapse is not here, not right now, not yet, but there is nervousness out there. Real quick, we got to see, did GameStop get to hold? Now, see, GameStop started selling off. So not everybody believes there's a short squeeze coming. And to the extent that GameStop sells off, it eases the fears of the other guys who might still be stuck in the trade. But it is up at around 168. So watch that one to where it ends today. All right. So what are you watching for this week? You're watching for how do the companies that report earnings fare after good news comes out? Are they selling it? If so, that's just building more. But if they're buying it, if everybody's buying and saying, hey, this is good news, let's buy some more. Okay. Maybe Gordon's wrong. Maybe the May 14th isn't going to happen at all. I'm not betting on it. I'm betting it's going down. I'm betting that Doomsday will come May 14th or before or slightly after, somewhere around there. And until next week, when we see how this transpires, take care and trade well.